Good evening, everyone. My name is Simon Misiewicz, and you're here now at the Property Experts panel. It's Monday, it's the 1st of June. So welcome all. Before we kind of get started, I want to just do a refresher of where we have been since the last 2 weeks. I think it's fair to say that Dominic Cummings is now auditioned very well for I'm a Celebrity, Get Me Out of Here. And unfortunately, he's got so many transport links, it's unbelievable. I think we also need to recognize our top leaders of the world. And apart from the dividing haircuts and bad hairdos that Trump and Boris Johnson have both got, I think they've made some brilliant decisions and some not. In the US, we've seen an increase in terms of sales for the equivalent of Domestos. And in the UK, we're not sure if we should be going to work or not going to work. Either way, I'm confused, and I'm sure we all need some sort of sanity as we go through the lockdown easing. Tonight, I'm, of course, joined by the Property Experts panel. So let's introduce ourselves. So Bronwyn, over to you first.
Hi, Simon. Hi, everybody. My name's Bronwyn Burncombe. I'm here with what I call my expert team, because all of these wonderful people that you're going to hear from today are part of my professional experts. And as a lot of you know, I'm a property investor. I also help other people learn. And I always talk about working with experts because I don't want to be an expert tax accountant, do I, Simon? And I don't want to be the best letting agent because how can I compete with these people? So it's great to be here again tonight. I know there's so many questions you've all asked. So I'm going to head on straight over to, let's go to Jenny. Should we go to Jenny next? Let's all go down the ladies first, I think. Off you go, Jenny.
Thanks, Bronwyn. Hello, my name is Jenny. I'm a property investor and a letting agent. I base myself in Southampton. We also work quite a lot in Portsmouth. Been doing this for about 20 years and looking forward to fielding your questions today. So over to Teresa.
Hi everyone. Yes, my name's Teresa Kaczmarek. I'm here representing the National Residential Landlord Association. I would just like to say thank you to Simon for hosting the event because I know he's just biding his time because he's waiting for an offer from the BBC, I think. So thanks for the appearance, Simon. It's really great to be here on a really good panel with lots of experience, as Bronwyn said. My experience is as a HMO landlord. I've got tenants on benefits. I'm also an area representative for the NRLA, which we're currently representing over 84,000 landlords. And during the lockdown, well, during this whole crisis, we have continued on supporting our members with advice, education and various information that landlords can tap into to carry on running the businesses, abiding by the legislation. We're also running webinars, and more importantly, we're lobbying on behalf of landlords as well, because we ain't half getting a bashing from those tenant support groups who, I think the latest one is they want to put a complete freeze on rents. So yes, we're lobbying hard against that one. So yeah, working on behalf of landlords out there. So yeah, looking forward to tonight. And I will pass on to Paul.
Thank you, Teresa, and a warm welcome from me in sunny Solihull, and I'm sure it's sunny wherever you guys are. I'm a portfolio investor and developer like some of the other people on this panel, but I'm also here representing the LNPG, Landlords National Purchasing Group. So some of you may have heard of us before, but for those who haven't, we're the largest buying group for private landlords in the UK. So put simply, we leverage the buying power of our thousands of members to get the best price for all the products you'll need for your refurbishment and ongoing maintenance of your properties. We've been around since 2011, but a lot has changed since then. And don't forget, members can now save money on everything from kitchens, bathrooms, boilers, building materials, blinds, light bulbs, and everything in between. So if you need to refurb, then make sure you come and join us. And we are currently doing a weekly webinar with all our senior partners. So I hope you managed to catch the managing director of CKS last week, which was a magnet kitchen manufacturer. And this week we've got Wolsey, who are the plumbing and heating merchants that are partnered with us. So find out more, go onto our website, www.lmpg.co.uk. And over to you, Simon Hodgson.
There we go. Right. Yeah. Good evening, everybody. So yeah, obviously I know all of these guys are on the webinar tonight. My speciality is finance, but I've been involved in property since the early noughties. So I kind of cut my teeth doing conversion work, so turning one-bed flats into two beds, title splits and what have you. And rather famously, back in those days, buy-to-lets was quite in its infancy. So I remember going along to a training organisation called Russ Whitney, who Simon Zucci of the Property Investors Network also went along to, which is quite interesting. Back, I think it was 2001, I think it was, when they used to teach us about maximising your credit cards and every unsecured area of debt in order to buy property. I'm not quite sure we completely advocate that these days. But what would happen back then is that there was very little knowledge. So what would happen is you would go along, you would go to a residential mortgage broker, you would ask them for a buy-to-let mortgage. Quite often, as happened to me, the broker would look at you, scratch his head and go, what's one of those? How do they work? And you're like, hang on, I'm the client, you're supposed to be arranging this for me. So what would happen is I would teach this person, this mortgage broker, which lenders to go to, which product he should be using for me. He would then charge me for the advice that I just given to him that he then gave back to me. And as you can see, I then became a broker at sort of a little bit further along there, just really mainly to do my own mortgages at the time. But then it kind of went on to do other people's and to be a broker. And that's really what I do now. I'm a property investor in the background, really believe in the asset class. And I guess the other angle really for me is that anyone who's asking questions in terms of strategies, I've done all of the strategies out there, and I've probably kind of found different ways to structure them that will help you in terms of your journey. So yeah, I'm looking forward to being able to help you. And also, I guess, a really unique perspective on the market. So next to, if you like, estate agents and valuers, I've really got my thumb and finger on the pulse. And I was just having a chat with the guys before we came online, just to really kind of reiterate where things are and what's happening with valuations. But I'm sure Simon will come along and ask me about that a little bit later. So I'm going to hand on now to Tim, I think.
Thank you, Simon. My name's Tim Bishop. I'm a solicitor and I'm also an investor and developer. I own a firm called Banalek and Bishop, and I've got about 65 staff, and we cover most areas of law you'd expect, but we have a number of specialist teams, including one acting for property investors nationwide, and another one specialising in lease extensions. And then if you do have any legal problems at any time, don't forget we always offer free initial phone advice to all property investors. So that's free initial phone advice to all property investors. Tim Bishop from Banalek and Bishop. And before I pass back to Simon, just a quick question. What's the difference between a lawyer and a vampire? A vampire only sucks blood at night. Oh, to you, Simon.
Oh, that's quite a good one, actually, Tim. I'll have to use that in my next show and then claim it, trademark. Thank you ever so much. As you will know, this session is really about answering your questions. So make sure they're good. No, only joking. Answer those questions is what we're here to do. So if you're watching and we're going through these kind of question sets and getting answers across, and you have additional questions, why not feel free to type in those questions into your comments box below this video, and I will make sure that I fill those questions out as well. I think the fair comment before we even get started is a number of questions that talked about valuations. It wasn't true. There's probably about 10 to 1 questions talking about valuation. So let's get this show on the road, and I'm going to go straight to that question, and I'm going to pop this question over to the person where the sun really does shine on the righteous, Paul Hilliard over there. With COVID-19 and kind of everything that's going on, what do you think is going to be happening with the property sector? We'll go to you, and then we'll go to Bronwyn straight after.
Everything's going to be happening. Oh, sorry, must stop doing that. Blinding myself in the sun. The current industry is, I think, all sitting on the fence waiting to see what's going to happen. My experience so far currently is the auction markets are very busy. Vendors are achieving great prices. So if you're in the selling, great. If you're in the buying, look elsewhere, because you're paying retail prices for products that in the main you probably aren't even going to be able to inspect prior to purchase. So just be very cautious. Obviously, until the estate agents are back up and running, are you going to be able to inspect properties? So it's very much, in my view, a wait and see, or look at other areas to invest in, such as commercial properties and the like. But be careful, because who knows what the market's going to do. The market could go up, could go down, could even crash. We had the boss of Nationwide last week saying that, in his view, there's going to be a slight dip. But when he was pushed, he was obviously quoting the Bank of England saying there could be a worst case scenario of 33% decrease, price crash. Who knows? I would say sit on your hands, don't jump. There'll be lots of bargains. And as the lockdown opens up, slowly but surely, we will see more and more opportunities, because there are some landlords who've not been able to rent out or lost rent during the period because their tenants are letting them down. There are a lot of businesses that, despite the furlough support, will likely go bust, and therefore there'll be lots of office space out there. And there'll be housing associations that similarly have struck the rocks, so to speak, and will be looking for assistance from landlords. So I would say sit and wait, observe, but be ready to jump at the opportunities. Over to you, Simon.
Back to Bronwyn, actually.
Yeah.
Let's get Bronwyn's view.
Yeah, so my view is, at the moment, we haven't got a crystal ball. We don't really know how big this recession is going to be. All we know is that how do recessions work, and what's happened in the past, and can we look at what's happened in the past and relate it to where we are today? And certainly the feedback I'm getting from valuations at the moment, literally in the last few weeks, is very, very positive. Not a massive change here in the south, of course. But if we look back at previous recessions and why they've happened, they've been because of financial, banking crisis worldwide, where banks' liquidity has gone through the floor. And that's so difficult to get back and running. And that has an impact on so many things. This time, it's COVID, it's out of our hands. However, we should be able to get back to speed. The banks have liquidity. The banks are happy to lend. People still need to live somewhere. So there's still huge demand for rental, in my opinion. Yes, people will be motivated to sell. Will they maybe thinking sometimes, maybe I was going to move, maybe I'll wait. So there may be those sort of people. It may not be, but there will certainly be people that need to move. So I'm really positive about what's happening. And I think that, time will tell, but the number of people are going to be unemployed, that might have an impact. Inflation, I'm not sure inflation will have an impact, will be massively impacted. Again, looking back at the economics of recessions in the past and comparing this one to that. So I still think it's a great time to be learning. I've got more people I'm teaching than I've ever taught before. They're really keen. And I know there's opportunity there. So let's see. I think Simon Hodgson has some very hot off the news press that might be of interest as well in this topic. Simon Hodgson, is he?
Yes, indeed. Yeah.
Yes.
Right. Well, can everyone hear? Yeah, you can hear me, can't you? So, as I said when I first did my introduction, I'm in a really privileged position because I've had valuers going out right from the day that the partial lockdown or the announcement of partial lockdown was kind of coming to an end. So I've had valuers going out, predominantly in the south, although there have been some stuff in the Midlands as well. And I'm really surprised, a little bit surprised I should say, but really pleased to announce that valuations have come in on point, and the valuations that have come in on point for the clients that I've been working with are for cases that have been submitted pre-lockdown. So these aren't figures that we've kind of had an external influence or been influenced via the lockdown. Those numbers were set, they were realistically set, not too high, not too low, and they've come in okay. And I think there's at least one, if not two, that I felt that we've actually gone in a bit low. We could have got the valuer came back so quickly and so easily. And when a valuer comes back really quick, that they didn't even have to think about the decision they made. So as it stands, it doesn't look that like the impending collapse of the market has materialized. However, there are many factors out there that can influence it. And I think we would all be in kind of agreement that we're almost in a completely unique situation whereby there are numbers of people who've gone onto furlough who potentially might well be then made unemployed as the furlough scheme sort of starts to come to an end. So we're almost watching, if you like, a bubble of the economy in the future, that we know there are forces on it, they're going to do things to it, but we're not seeing the effects right now. So therefore market sentiment has really continued on from what I'm seeing from where it was. It's not changed. And that was also backed up with valuers that I'd spoke to before they'd gone back out. So the expectation was that they didn't see things changing. But hey, there we go. Amazing, eh? Bronwyn, you're on mute, I think.
I am, but I was over back to Simon.
Yes, I was just going to say thanks for those insights. I think what was interesting about the whole thing about COVID-19 coronavirus is that there is going to be a call for recession, and I think most times if you look at the FTSE 100, the DAX, etc., NASDAQ, you'll see that the fluctuations are very reactive. They're not responsive. Reactive means no knee-jerk reaction, and I think typically we find the stock market does reflect a panic more than a genuine, right, this is what we're going to see. If you look at the way that FTSE 100 is now, around about the 6,000 mark, compared to the 5,000 that it was just a few weeks ago. So I think the sentiment around the economy isn't really known yet. And we don't even know if COVID-19 has really changed. I want to change tact because I think we've often thought about COVID-19 recession and stuff like that. I think I want this to be more of a positive step of kind of where we want to go. And here's a question I'm going to throw to Bronwyn, and I'm going to throw to Teresa to get Teresa on there. I can see the sunshine on Teresa now. I think the moons are aligned. So we're going to get Teresa on this one. And here's the one for you. Here's the question is, if you are writing, if you're looking for properties, and you see these envelopes or these letters come through asking, are you looking to sell your property for cash? What kind of methodology, which days, if you are going to be doing leaflet drops at all, you use handwritten or typed to get people's interest to try and sell their houses for cash? Mm-hmm. And let's go for Bronwyn first, then Teresa second. Let's do that way.
Brilliant. Yes. So it's a good way to approach people, is to understand who are the landlords out there, who are people perhaps wanting to sell and maybe targeting a particular street that you know and are interested in. I think the approach ought to be a bit more personal. So if you can, get to know who they are, maybe drop something through their door if it's local. If it isn't local and you're targeting a different area, then handwritten envelopes for sure, so that it looks like it's much more personal than a leaflet drop. I've had a lot of letters, landlord letters, for HMOs and that sort of thing. Would I like to rent my property to them? All my advice to people who are doing that is, if you've been on a course, change the wording a bit, because I've got like 4 this week, all the same wording, and it just doesn't look professional. So make it a bit more personal. I've got a few properties in 2 locations, and again, don't send the same property, same person 2 letters. You send me 1, you know, so use your common sense. And then if you can find out telephone numbers or contact details, LinkedIn, you know, contact people on LinkedIn. It's a professional place. You know, I love it when people connect there. It is a professional place, and I would fully expect people to find me with a name like mine. It's not difficult. And to connect in that way, in a much more personal way through social media as well. Teresa, have you got anything to add to that?
Myself, I mean, I would just coming from a stance of communicating with tenants and sending posts to them, because at the moment, you know, there's lots of questions about, you know, my tenants not communicating with me. You know, how do I send a letter to ensure that they kind of open it and read it? So the recommendation is, you know, well, handwritten is fine or typed. Definitely go to the post office, first class stamp, and then obtain a certificate of postage, and ensure you keep a copy of that. So keep a copy of your correspondence and a copy of the postage, because in the event that it does go to court, you know, you've got evidence and proof that you have, you know, sent them a communication regarding that. But otherwise, yeah, no, I've got nothing further to add from what Bronwyn said.
Okay, fair enough. I'm going to throw a different question, and this is an interesting question that's just come in hot off the press. So if you ever think that this is not live, it clearly is. So this is a question now to Tim. Again, the sun is definitely shining on the righteous over there. It's unbelievable. The question is, Mayern has got a property in London, and it's been split into 2 flats. Now, it's one house typically, but it's been split into 2 flats, and they're not sure if they had planning permission to do so. What are the safeguards around converting it back into a one household again? Are there any kind of things you should watch out for?
We're not planning specialists, and I think you probably need to double check with actually our planning specialists. There aren't that many of them, but I think the first thing to do is actually you need to make sure you've got planning permission. You know, it's a pretty basic thing. If you haven't got planning permission, you can have issues. On a more dramatic scale, there are many examples of people who fail to have planning permission, and actually, if they put an extension up or built a house, actually has to be knocked down. I'm sure it won't be that kind of situation, because splitting a house into 2 shouldn't be a problem. But if there are planning issues, then I would check with the planning lawyer.
I guess from your perspective too, is it not safe? I mean, if it was a single house, the person beforehand split into 2 flats illegally, let's say, and they want to convert it back, shouldn't be an issue, should it?
I don't think so. You know, it's quite common. I've got a block of 6 flats that I converted from a commercial building to residential, and I haven't split it. I rent them out individually, but it's under one freehold. I haven't bothered to have 6 different ones, so it's quite possible to do that. I don't think it's going to be a problem, but I would just double check first.
Okay, that's a good point. Simon, just over to you. There's another question that's is very interesting about lending, and people are talking about limited companies, and there is some tax questions about limited companies. I have warned people again so many times about not asking tax questions, but they keep ignoring me, and that's fine. They've had 3 strikes and they already have been booted off. From your side of things, getting a mortgage in your own name versus a limited company, how much more difficult is it? Is it the same? And what kind of rates can people get?
Okay, if I take the easy versus hard bit, it's no more difficult to get a mortgage in a limited company name, because the bulk, 99% of limited company applications are for companies that don't have a trading record. What the lender does, the lender effectively credit checks the directors, which are effectively the normal applicants. So you go through the same credit checking process. The only things that differ will be on the back end. First of all, you'll need to give a personal guarantee. So just imagine if you have the mortgage in your own name, you are 100% liable for 100% of the debt that you have with the lender who's lent you the money. If you borrow through a limited company, if there are no personal guarantees in place, you have absolutely no personal liability against that debt. So you can effectively hand the keys back to the lender, and there's not a lot they can do. So what they do to kind of safeguard that situation in terms from a lending perspective is they will ask you to give a personal guarantee. Now, in order to give a personal guarantee, you will need to generally get independent legal advice from a solicitor who is not the solicitor carrying out the conveyancing process, or i.e. in Tim's position, it will possibly be someone else from either within the same office or from one of the other offices that can independently give advice to you whilst you sign those personal guarantees. So there's a little bit of extra in terms of cost for conveyancing, but other than that, it's not much different. And then rates. So rates, typically the biggest difference in terms of rates are if you are using, it's a single let property and it's in your own name. Typically rates at the moment, the best rates are 75% loan to value are around about 1.59%. If you match that against limited company, it's 2.84. So there's quite a difference in terms of cost. You know, 2.84 is approaching twice what 1.59 was. So it does make a really big difference, and you do definitely need to speak to a tax advisor. Not sure who we can find one of those anywhere, but if we do find one on the panel. But where they kind of converge a bit is if you are buying properties for income, i.e. you are subdividing and creating a house of multiple occupation, and generally you've got 5 or more rooms or possibly 6 or more, then the rates pretty much are the same. There's no real difference between having a limited company mortgage or a mortgage in your own name. That space, you know, the lenders that do those kind of specialist HMO mortgages will lend to either a limited company or a personal name. So 2 things it will come down to: your tax position before you start out in terms of what your application, you know, your current tax status, and the kind of asset you're buying will then dictate whether you go a limited company or personal name.
And just to echo that point, and thanks for that, Simon, the thing I always get asked the question is, should I invest in a limited company or should I invest in my personal name? And even now, people are asking the same questions on YouTube chat. My honest answer to that, and Tim and I conversed on this very subject 2 weeks ago, saying you need to get specific tax advice and legal advice for your specific circumstances. And I'm not going to kind of brush that off, but it is so true. I have no end of onboarding calls with new clients, and they bring with them a limited company, almost like the long lost friend. I've got this mate limited company, I'm not sure what to do with it. It's like, well, why did you set it up? Oh, because my other mate told me to get this friend called limited company. It's like, well, you need to first understand your tax position, not just now, but also in the future, not just get your mate down the road to give you 20 years worth of tax advice over a beer. It just doesn't make sense. But people do tend to set up these limited companies because they think they're getting a tax break of some type. But as Simon's just alluded to there, that mortgage interest rates are higher. I often have said that it's 1%. I'm glad that Simon is so good at math saying it's double. You know, it's brilliant that we've got people who can do numbers on this show. It's brilliant. I really thoroughly appreciate that, Simon. Thank you. But from the side of view of mortgage interest, not just that, but we've also got a tax position whereby if your corporation tax is 19% and you want to take it as a high rate taxpayer, you're paying dividend tax at 32.5%, which again is 51.5% in tax rates. So it's not the best thing to do all the time, especially if you need all of your money. People also use limited companies to say, well, I need a limited company because my accountant has told me so, without asking the question that most of the people listening to this show are looking to invest in property and give up their job, just like Bronwyn did. And they are setting up a limited company straight away. And I kind of think that's the wrong way about it, because sometimes you may as well have just properties in your own name, suffer the initial tax problem, and then later on you're in a better tax position because you've got them just in your name. You've got better buy-to-let interest rates in your name. So please don't rush out, do get tax advice and think about the long term. Don't just think about the here and now. Think about really the long-term picture between you, your spouse, and indeed your family members. So hopefully I've answered that as brief as possible. I appreciate some people say it's artistically vague, and it's not meant to be too vague whereby you can't get an inkling, but you do need specific advice for yourself. So I shall end on that point. And any more tax questions, like I said, I will terminate like Arnold Schwarzenegger in this show. So let's talk about something a bit more in terms of lettings. Let's get Jenny on board because we've not really heard. Jenny, from your perspective, what are we seeing in the marketplace? We're obviously seeing more viewings now from a lettings perspective. Is demand now beginning to resurface, or are people that are looking for property still a bit nervous?
Well, our experience definitely has been that as soon as they lifted the partial lift, we were inundated with people that wanted to do physical viewings. Prior to that, we were doing viewings by video, and people were seeing that, liking the properties, but then wanting to do the viewing as well. So it's been very busy on viewings for sure. Lots more inquiries than there have been. It's still not as buoyant as it was pre-lockdown. However, it really has picked up quite a lot. We've probably got rid of 80% of the rooms in the last 2 weeks that have been on our books. Now, we're not a big letting agent, but even so, if you can act quickly to get people in when at times that suit them, you can generally do the deal because they've seen the house beforehand, they've asked you all the questions, they've done the video. And so you're only going to viewings when really as that very sort of final, well, just check that actually this is the room we've been talking about. This is the house we've been talking about. I'm not trying to sort of fob you off on a different one. So it's that sort of final thing. So when we're doing the viewings, it generally turns into a let, which is great because it is saving time. I'm finding that people are open to answering a lot more questions than they were previously. They understand the reasons why we need to do that. When we're doing viewings, people are very happy to come with masks and gloves and sanitizer and so on. People are respecting social distancing, and we obviously do remind them about that, but they come willingly doing that. So from that point of view, I would say the market has definitely picked up, and there's been activity in both Southampton and Portsmouth over the last couple of weeks. Is there anything more? I don't remember if there's any other part to that question.
That was great, Jenny. I don't know where Simon's gone.
Simon's
gone.
Unmute yourself, Simon.
No, I just decided I didn't want to talk to you anymore. That's as professional as I can be. Apologies for that. I was going to say, Paul Hilliard, if you don't mind, with my professional faux pas I just gave, but it's recovered very well, I thought. The Beeb really aren't going to hire me now. That's it. So it's done. I'm definitely ITV. If you're looking for a, I appreciate you doing someone, given the host that you've had. You're on your man. So Paul, if you don't mind me asking about Airbnb holiday lets, do you think we're going to have a surge in the UK because people won't get on planes?
I don't know, won't get on planes. I don't think they will want to get on planes. But someone like you'll get your own private jet, won't you, Simon?
To be fair, I was going to put on YouTube tonight about my own private jet. It is sponsoring tonight's show, so yeah, and sponsoring by Pepsi as well. Just as a thumbs up now. Back to you, Paul.
Right, back to me. Yeah, Airbnb and Booking.com, although they are again locked out until the end of June now, July the 3rd is when they're starting to open up their bookings. They are allowing key workers to book. But similarly, I'm finding that apart from just one of my SA units, everything's fully let to contractors who are out there busying themselves and doing projects for property developers or other businesses. So the market itself is very buoyant. As regards the future, I think what's going to happen is that, as someone correctly predicts, that people aren't going to be able to get away so easily. I mean, if you can get away, are you going to be able to afford to take 2 weeks holiday as a self-isolation when you come back? Who knows what the situation is going to be. So if you've got holiday lets in the UK, that sounds like good news. and there'll be opportunities there. And similarly, if you've got service accommodation units for contractors, then that's going to be good news. I think as regards holiday breaks and whatever, I think for the short term, that's going to be unlikely until lockdown is fully released. But I'm sure there's other people with other experience on here that may disagree or agree. Over to you, Bronwyn.
Put my hand up. I absolutely agree with you. I think the interesting thing is what's happened with my holiday lets, and I don't have many, but I've just let my own home, which is a holiday let, for 4 months. So it's interesting that there are people out there who are perhaps having their house done up, or they've sold their house, and the other house has fallen through, and they need somewhere that's fully furnished to just move into with the whole family and 2 dogs. So a 4-month letting there has been great. And then in the other one, through Airbnb, through the person that's managing it for me, you know, contractors, lots of contractors out there coming down. They want the work, they're needing to work to travel to where they're working. And they'll stay for, you know, several weeks, potentially, maybe Monday to Friday. So there's different demands that I'm seeing for sure. And, you know, I think staycations, will be on the rise. What we won't have are the foreign people coming to the UK, you know, so your city centre visitors probably won't be very buoyant this year for sure.
Talking about another sector, let's talk about commercial properties. And I'm going to you, Simon Hodgson, and in fact, we'll start with Simon first. What do you think about the different types of property strategies, and indeed talk about commercial properties? Is commercial one of those forgotten about sectors that people should be tapping into? And I things like offices, hotels, restaurant, cafes, that kind of thing right now is not so much in demand because they're all shut. But in the future, could commercial property come back, do you think?
I think it's definitely going to come back. I'm not sure how the others feel about this, but definitely what we've really experienced is a complete change in the way that we shop. And I, for one, have found it really quite convenient to not necessarily have to spend too much time going to visit shops and getting stuff delivered. So I think potentially that's going to change how we shop going forward, and the experience type shop has got to continue. The restaurant type experience, again, I guess, has got to continue in some sort of shape and form. And within the commercial world, there's something that's known as strength of covenant. I can't remember if I covered this last time, but strength of covenant. So if you've got a shop that's on, let's say, a 15-year lease, and you have got Costa as your tenant, your commercial property can be, in some cases, worth twice as much as a shop a little bit further down the street that has got a one-man band who has just started trading, just taken out a lease with you, still might have signed a 15-year lease, let's say with an 18-month break clause. Now, clearly their business is obliterated right now, and how they can come back from this seems quite hard unless they've got some really deep pockets. So from that perspective, commercial, if you've bought that kind of commercial property, it's going to be very difficult to make work in the future. So I think how commercial operates on the high street potentially is going to change. Potentially the kind of asset owner for those types of tier 1 type leases might well be the investment institutions looking to chase the institutional type money, and the fringe part of the high street, which has already suffered so badly. I really don't see how it can continue to go on particularly any further. You know, the commercial to resi type conversion that we have been doing as investors surely has got to be the right way for those types of properties where we've got such a high demand for people to have a property, and we've got shops empty with changing habits, forced changing habits, I should add. So a long answer, I guess, to that question. Is it a strategy that we should continue to think about in the future? I think very carefully. It needs some really, really careful due diligence to be done about it. I think as an investor, you really should get yourself educated. And there are some great people on the webinar tonight that can help you do that. Probably start out potentially with a single let property, cut your teeth, maybe doesn't even need to have too much work done to it or needs a small amount of refurb. Then maybe go up to the higher yielding house of multiple occupation, or buy a house and turn it into flats before you get onto commercial, because commercial is a whole different ball game. It's got some great yields if you get it right, but if you get it wrong, as we can see now, you know, we're going to come out of the coronavirus, and as Jenny was saying, there's demand for properties to let, but I bet we're not going to see that on the high street on commercial. Commercial brokers are going to be kind of going, right, the next 6 to 12 months is looking pretty difficult. And there's no reason to suppose that that's going to change much. So, yeah, do it, but do it with caution.
Tim, what's your thoughts?
Can I add something?
Teresa, if you want to fire in, you fire in.
Thank you. I just wanted to backtrack slightly to the Airbnb situation, just to give a heads up to the audience that this sector is undergoing more scrutiny with government because basically, you know, there have been issues with Airbnb. The main concentration in London, where there's like lots of antisocial behaviour issues. So where where you've got a high concentration of Airbnbs, there are definitely issues with antisocial behaviour, and it's disrupting local communities as well. And also councils have an issue with them because with regard to health and safety enforcement, and also, well, the government are aware that there are tax evasion as well with Airbnb. So we're just a heads up really. So, you know, you're probably going to hear more legislation coming out surrounding that. Okay.
Yeah, good point. And again, you know, you hinted at the word tax there, Teresa. Strike one. Let's not have any more of this. Come on, people. Tim, over to you. Let's talk about commercial properties then. Is it a good sector? Are you finding people are beginning to inquire about commercial properties and transactions in regards to commercial properties?
I think, like a lot of things in the current situation in the next couple of years, there's a danger of looking for simplistic answers, and I don't think one size fits all. So when we say commercial, what do we mean? Commercial has such a wide variety. So there's a huge difference for retailing. Retail, it's fair to say at the moment, is in a really bad way. Some may be converted, but again, the government have only got very limited abilities with planning to allow you to convert. And some of the really big units in Salisbury, Debenhams is closing. I can't imagine anybody doing something good with it because most of it's dark. If you're looking to convert a commercial building, you need a good footplate, and this has got very bad footplate, a little bit of light at the front, no other light. I don't know what they're going to do with it. So I think it does vary. Offices in central London, big offices, I wouldn't want to be sitting on those. I think some of the big London firms will let people out or will have part-timers. On the other hand, a small local office might do very well. So I think it's very much, local and also particular sectors. And I think that is going to apply to the whole of the property community. I think there's a danger we rush into things. So again, with service, it depends what you've got and where you've got it. If you are dependent on the airline industry for whatever reason, then I think it's looking really bad for you. On the other hand, if you're in a place where people do want to go on holiday internally, then I think it could be quite strong. So I think very much it's a game of two halves. It's not one size fits all. And I think the other thing I'd like to say, I was going to bring this up earlier, I think everyone wants to know the answer now. They want an instant answer. We live in a society where everybody wants to know everything tomorrow. The mobile phones mean you have information instantly. But with recessions, what history has always shown is they don't come in instantly. Recessions are a gradual thing. Looking at the economic failure in the last recession, it was something like 3 quarters between the recession starting and the UK economy hitting its bottom, and then another 3 quarters, i.e. 9 months, before going up again. So I think everyone's saying, oh, well, what's happening now within 2 weeks? Doesn't give an accurate view of where it's going to go. I firmly believe in waiting and seeing. I think at the moment we're getting a bounce because there was a lot of pent-up frustration and a lot of activity, people wanting to do things, a lot of enthusiasm. But that's it's a bit like a shaking up a Coke can, advertising again. I hope you're going to do well with that. Shaking your Coke can, it's very frothy, it explodes. But actually after that, we'll have to wait and see. So I think my comment is it's not one size fits all. Part of commercial will be very good, but let's wait and see.
And with that explosive ending to your comment there, we'll move on. Let's talk about HMOs, Jenny and Teresa. Let's get you involved in here. And this is talking about the safety of the tenants. We obviously know about there is a demand, but how can a landlord proactively safeguard tenants? I'll go to you first, Jenny. What's your ruling around safeguarding and communication to tenants?
Obviously, everything's slightly more complicated when you've got a shared house, because you've got potentially 5 or 6 people in a house that have their own agendas. So the sort of, simplistic answer is, when you're going to go and do a viewing on the property, you obviously let everybody know. Let's say the viewing goes well, the person wants to move in. This is where we're at now. So moving somebody into an HMO. We always ask the person moving in to do a health declaration. And at the same time, we will have been asking frequently the current tenants to keep us updated with their health status, so that we are not knowingly putting an infected person into a clean house, if I can use that terminology. We always ask people when we're doing viewings if they could either remain in their rooms or go outside or be out, so that there's very little chance of people bumping into each other. Contrary to what we really want to do is let them all meet each other so they can see if they could get on as housemates. When we're moving, obviously cleanliness is another really important thing. We've got to make sure that the house is being adequately cleaned, the room specifically cleaned, so that somebody coming in isn't going to be infected by joining the household. And we keep talking to our tenants, reminding them about cleanliness, about not sharing tea towels and washing up and drying up and putting away and wiping down surfaces, etc., particularly in the bathroom and the kitchen. But we can't enforce that. So you get a feeling when you go into a house if it's a clean house or if it's not a clean house. Now, we generally have cleaners going in every 2 weeks. We are considering upping it up to weekly cleaning now in our houses, and I think we probably will be moving to that quite quickly. But there's still that period in between the cleaners going in when the tenants have to take responsibility. And it is down to education, notices all around the house, reminders. But bringing somebody into the house, they've got to be comfortable that they're coming into a clean house, and they would have seen that on their viewing. And the people who are in the house are also very conscious. They don't want us bringing someone in who is likely to bring the infection with them. And in most cases, I've found that the tenants have been very open about their health status and wanting to be sure that the person coming in is the same. So again, communication, as we've been saying all the way along, very important, and extra cleaning and more questions. That's the way that we are doing it and managing it. And we have moved in 3 or 4 people since we were able to start doing viewings, and it's been fine in every situation. But we've got 14 days isolation, really, haven't we? We can't make the tenants stay in isolation, but we will only know after 14 days whether that person brought something into the house or caught something from the house. But as far as we're aware, we're running clean houses.
Teresa, what's the view from NLRA?
Right, sorry, I was struggling with the unmute button there. Yeah, I would just agree with Jenny on the point that you can't enforce it. All a landlord can do is to take steps to communicate with the tenants and to educate them. And then to make sure that you've got evidence that you have, taken the necessary steps. So the NRLA and the government have very specific guidelines for HMOs. So this outlines, what to do if somebody within the household needs to go into self-isolation, what steps should they take, and what steps should the rest of the household take. So I would highly recommend that you upload those instructions and just pass those on to the tenants. I mean, as soon as we went into lockdown, I sent that out to my tenants in my HMO, just so that they were aware what to do if any one of them became ill. So yeah, that's my little addition there.
Can I just come in there as well? I'm thinking about future and what people are going to be providing for people in their HMOs. And I think obviously en suites are going to be much, much more popular. I think it makes sense, doesn't it? It's their private space. You're not sharing then bathrooms with other people, and perhaps that's seen to be less risky. So if you can provide more en suites in the future, perhaps some working space for people, that's probably the way to go. Particularly for those that are more fearful of being in a shared house, perhaps. That's my...
Bronwyn, from your perspective, are you seeing more of a demand, not just of en suites now, but little kitchenettes for people to make their own food or anything like that?
Not kitchenettes, no. I provide those for short-term accommodation in some of the guest houses that I have, where families can be together and cook in a very large room. That's very different, but not necessarily in an HMO. But then all of mine are 6 or 7 beds. They're not any bigger than that, and the kitchens are usually quite large for that amount of people. I think there is a trend for larger HMOs, in which case I think that's going to have to be the case. You know, certainly more than one kitchen and more en suites. But you know, I think there's this co-living phrase as well. There's a lot of this sort of co-living idea where, you know, it's an environment with lots of shared space. I think that's, you know, it's quite attractive for people, particularly if they've been in a flat, maybe a 1-bed flat, and it's really expensive for them. It's a lot cheaper if they're in shared accommodation, and if they're with people, it's a much better experience overall.
I appreciate that.
So can I take over being host? I'm only joking. I just want to ask Bronwyn a question with regard to that providing en suites. Are the councils down there really hot on, you know, keeping a track of those types of accommodation? Because, you know, they are quite keen on putting a council tax per room, aren't they, in those types of properties with those facilities?
It depends. Everywhere's different. I think, you know, they've got very, very specific guidelines as to the size of the bathrooms and the number of toilets, etc. I haven't seen it. I think if you provided kitchen facilities as well, and it was self-contained, then fair enough. So as long as you don't have a microwave and a fridge under the desk, which I know some people do provide, we don't. But, you know, if there's any grey area that it's self-contained, that will give them a chance to say, oh yes, well, I can charge you council tax. I certainly haven't experienced that down here in Southampton or Portsmouth. I don't know, Jenny, whether you've experienced that. Sorry, Simon.
Sort of. We are currently taking out cooking facilities from a large ensuite room to make sure that we don't fall into that trap.
I think it's just worth checking with the council, isn't it, in your area, to see, you know, whether they'll clamp down on you on that or not, because that's really going to affect your cash flow. Yeah,
that's all valid points. Going on from getting Simon on this one now, we'll talk about, in fact, I'm going to ask it of all the panel experts now. Just raise your hand just quickly if you've applied and obtained a bounce back loan. Is there any of our expert panel that's managed to go for a loan? All right, well, Paul Hilliard, let's go over to you. What's talk us through. There is this been whole debate about property investors back loans. They put some exclusions, but I didn't see anywhere about an exclusion of property investors or property developers. So tell us about your experience, and then straight over to Jenny.
Well, I've applied. I haven't received it yet, but I've applied from one of my limited companies on the basis that that's the only benefit I can see from these things. But one word of caution I would suggest is that there is rumours afoot that the lenders won't look kindly on companies that have applied for bounce back loan. Well, sorry, not applied, but received bounce back loans. So I think they will be looking for you to either repay the bounce back loan or prove that you've got the funds available aside from the bounce back loans if you do want to go and do any acquisitions. So just be careful. I think I saw one of the questions, somebody saying, I'm new to this, can I get a bounce back loan? If you're not a limited company, and I think sole traders may be able to apply, but you've got to be able to prove that you are trading, and most landlords aren't trading. It's only if you've got the service accommodation business that I have with my limited company that I'm able to do that. So, yeah, I've applied for 25% of the turnover of one of my limited companies, and wait to see if that comes through. Don't know if Simon Hudson would agree that commercial lenders will go, "Whoa, what are you doing?"
Yeah, that's a really interesting one, Paul. Yeah, lenders are very slow on this one. It was really very obvious to me with the mortgage payment holidays. Don't do it. Don't do it. Don't do it. Don't do it. Unless you absolutely had your back against the wall and you had to do it. Because how can you possibly take a payment holiday from one lender and then apply it a week or two later with a new lender to have a loan? You're not mortgageable, clearly, because you've just said that you need a payment holiday because you can't afford it. But with the bounce back loan, it's a bit different. Now, very early days, I've had a couple of lenders where there was one property, so one property in a limited company in an SPV. Now that limited company was taking a bounce back loan, and the lender wanted to understand how the loan was going to be repaid, what the repayments were, and to take those into account in terms of affordability. So across one property, that makes sense. Across a portfolio of properties, it's a little difficult for them to try and pinpoint the whole loan to one particular asset and stress test it in that way. So far, lenders are reasonably accepting. So, and I say caveat that, reasonably accepting of bounce back loans. However, I have heard of lenders starting to look in the background. Well, if you've applied for a bounce back loan, potentially that suggests that your business is under stress at some point. We as underwriters haven't necessarily found or identified where that stress is within your company, but we know that you feel there's some stress on it. And can you potentially help us understand why you needed the bounce back loan? Now, that can be quite a hard question to answer, especially correctly to an underwriter. And it does require a bit of thought process about how that is presented to an underwriter to make it acceptable. Because in a lot of cases, underwriters aren't trying to scupper the deal. They're just trying to protect themselves in the eyes of the FCA and the Prudential Regulation Authority. So if they are in the future audited, and they can be, it can be shown on bank statements that are held on file for that application, that the lender knew you had a bounce back loan, they need to show that they've asked the relevant questions about that loan so that they've covered themselves effectively. Now, the major high street banks will be the banks that will probably put up the most resistance to bounce back loans. Your Lloyds, your Barclays, your NatWest. I definitely believe they will come along at some point and kind of suggest that having a bounce back loan is not or difficult for them to work with. But for the moment, I think the general consensus is that a bounce back loan shouldn't unduly affect your position.
Good one. Jenny, let's get your feedback on that.
Okay, so my bank manager rang me up and said, I think you should apply for one. I said, well, I don't think I need it. And she said, it's free money. Why wouldn't you want it? I went, okay. She said, the only thing you can't use it for is to repay an existing loan. I said, okay. So I made an application through my limited company. The money was in the bank in about 3 days. It was quick, it was easy, interest-free for the first year. And then I've got the repayments for what is effectively a 6-year loan, isn't it? It's 5 years of paying back. I've got a nice big lump sum of money in my limited company. Now I'm just buying a new property right now, but I'm buying it in my personal name. So it won't in fact affect that at all. What it's done, it's really bolstered my limited company because I've got money to work with in there as well. So I saw no downside to taking this loan, and it was the easiest loan you've ever had. You just said, oh, has your business been affected by COVID-19? Yes, it has. I've got one member of staff furloughed. So yes, obviously that's affected me. And for a while, we were having to do things very differently. So I answered honestly, yes, it has affected me. That was about the only question, actually. And then it was, how much do you want and when do you want it? And it was in the bank in about 3 days' time. Fantastic, free money, which now takes a strain off the business, which means I can go in my personal investment property investment that we were doing before, but with a little bit knowing we don't really have to support the limited company, because that's already supported by this government loan. So I saw no downside to it. Frankly, it's cheap money.
Talking on that similar kind of train of thought about getting money out, bolstering your balance sheet, and thanks for Jenny for that. Another strategy that seems to be kind of containing all of this is refinancing your properties. Now, years and years ago, people talked about buying a property, refurbish it, adding value to the property, then refinancing it, getting money out, and then recycling that process. And for my money, that used to be a sound strategy, because you expect that the capital values in this country would increase. Back in 10, 15 years ago, that would certainly play out. But now we're in a situation where capital hasn't increased over the last 5, 6 years, and who knows what's going to be in the next 5 years. But we've also got things like Section 24, mortgage interest relief cap, whereby you don't get the tax relief on the interest that you have on a property. Therefore, you could be handing more money over to the banks should interest rates increase over time, and the amount of tax that you pay to HMRC. Let's hand this over to Bronwyn first, and then Paul Hilliard. What's your thoughts about the buy, refurb, refinance strategy?
Yeah, good question. It's certainly having there's a lot of people talking about, they call it BRRR, and I never knew that term until just a few weeks ago, funnily enough. But in terms of adding value and then creating value by refinancing, that works day in, day out. I don't think anything's changed with that. You've just got to ideally buy below market value if you can, to give you that additional opportunity. If you're prepared to take on a project, and not everybody is, but if you're going to convert something from a smelly house through to maybe something really nice, you're adding value. If there's a problem with that property now, maybe it's not mortgageable, that's a much bigger opportunity. And then if you're going to create additional bedrooms or additional dwellings, converting to flats, for example, then absolutely you're taking value from what you've done. I've done the create an HMO from a 3-bed house, and then I've remortgaged onto a 5 years ago now. And yes, those mortgages are very expensive. So they have caused a problem, in that, the mortgage is a high mortgage, and it's not on a residential low rate, but I can fix it still. But it means that I've got to manage that. But the good thing was, at the time, short of cash, able to take cash out, do another one. So it's a great strategy. You've just got to be really good, get a great education, be really good at finding the right deals, and it's the cheapest way of borrowing. So that's my current view.
Thanks, Roman. Yes, I totally agree with you. It's one of the best ways for an individual to expand their property portfolio. It's the method I've always adopted since day one, and that's well over 20 years ago. And I was going to say, the one thing to have been careful when you could apply your tax relief was that you could only apply it to the original purchase price. You couldn't borrow more than that when you were refinancing to claim the tax relief on the surplus amounts over and above the purchase price, as far as I remember, if that's right, Simon Mizovic. But the other side of the coin, I'd say, is that I've also used bridging to purchase a property and convert it into a 6-bed HMO, and then made money by refinancing it and getting all my money out and covering all the bridging loans. So it's a great way to do it. But obviously, you do have to have an unencumbered property to be able to do a full bridging on that basis. And that was on an auction property. So, great way to do it. And definitely, if you're into HMOs, then it's a great opportunity to convert a as Bronwyn says, a 3-bed into a 5 or 6 bed. We discussed a few sessions ago whether someone should do a 2-bed into a 3-bed HMO, and I was suggesting that really was a bit tight. And I'm sure, once you've done it, you will go, yes, I'm not making as much money, and buy refurb, refinance is the way to go. I must admit, I used to do it the old-fashioned way, and used to do the refurb myself, and that took months when I was working. So, don't do that. You are going to save much more money, or not save money, but you'll make more money by using a professional tradesman to do the refurb for you, and get that property let far sooner than you will by doing it on a part-time basis. So, hope that answers the question, Simon.
I think taking all your money out is very difficult. So I just want to add that one. People come to me and say, I want to learn how to take all my money out. It's really, really hard. You've got to get really good at what you do to find below market value to do that. I don't know many people that have ever.
Thank you. I do.
I think a couple of things on that, actually. I thought buy, refurb, refinance is because someone's got, but that's just my naivety in property investing, clearly. Simon Hudson, over to you. Let's talk about financing. Is it now possible? I have heard from clients that talked about they've done this strategy, buy, refurb, refinance, but the valuers are kind of restricting what they're valuing the property up at. Are you seeing that kind of resistance from banks?
Yes and no. The skill from the broker's perspective is to understand before the client buys the property what the end goal is, what they're trying to create, where it, in which town it's in which location within that town it's in, how many bedrooms it will have, how many en suites it will have, and then work out who the most likely lenders are, and then to work out who those lenders will pan out to value, and then understanding those particular areas, who is a bit more optimistic and who's a bit more pessimistic, and that can potentially then point us in the direction of a different lender than might be the absolute cheapest lender, because we can be a little bit more sure that a certain lender will give us the value that we're after, which will allow us to get close to that nirvana of recycling our cash back out to go and get the next deal. So sometimes having the cheapest deal isn't necessarily the right thing to do. And it's really key to, from my perspective, to understand where you want to end up. The other thing to remember is that whether we're going to go for a bricks and mortar valuation or whether we're going to go for a commercial valuation, and then how much experience you've got, because it's not always possible to jump straight to a commercial valuation if you have little or no experience. However, that can allow us to value the asset as a business and on its income. And typically 6, 7 or more bedrooms are where that really comes into play. In terms of lenders, obviously this is a closed forum, so we are not to be posting this back out onto other Facebook platforms, but I can say confidently that if you are going to be borrowing from Paragon, they have their own in-house valuers. Now, what do you think an in-house valuer will do? Yeah, given the fact that they are paid by the person that's sending them out to go and to make a valuation, and if they get it wrong and there's a change in the marketplace, you might find that you're having a rather difficult conversation with your employer. Yeah, not your PI insurance company. They are most definitely cautious valuers. Yeah, and I only ever use Paragon if we're absolutely sure that we're not needing to push the boundaries of evaluation, that we are going for something that's really very easy to define in value, where there are some really good comparables that we can show to a valuer so that it's hard for the valuer to disagree with the value that we would put forward, or at least they can't use other comparables that they feel are more relative to the deal that bring the value down. That's probably the worst lender, I think, in terms of, but they've got some great deals. Don't get me wrong, Paragon are really strong in terms of deals, and there are circumstances where they will allow a commercial valuation to take place on a property that other lenders wouldn't, particularly. If we're going for the more vanilla type lenders, then they are using comparative method evaluation, and Connells can be a bit of a challenge at the moment. I found Connells, to be honest. but not in every circumstance. It's also worth noting, actually, I should point out that as we've come out of the lockdown, Connells have had a backlog of valuations to do, and they've not been able to keep up with the work. So they have had to panel out to other valuers in the local area to do their work. And that is where I found the greatest benefit, because it now hasn't gone to Connells, it's gone to someone else who actually understands the asset better. Long answer, probably to a short question.
No, used to that, Simon. That's why we've extended the show till 9:30.
Brilliant.
Anyone listening, that's
good.
not true, by the way. That is not true. Over to you, Paul. I've got a question. Someone's been asking the question on tonight's show, as well as the questions beforehand, asking about refurbishments and using for materials. Are you finding that material prices have gone up, and will they decrease? And equally, what about people in terms of how much they're beginning to charge because they can't get access to properties? They're high in demand. Can they charge what they like now?
What we're finding with LMPG members, that the prices are generally fixed, apart from those products that are proven to be very, very scarce, such as, dare I say, plaster. If you've got multi-finish plaster, then you're sitting on a bag of gold almost. And that's because, it's a British-made product, and they've suffered from having to close down facilities, and then when they opened up, it's everything's social distancing. So instead of running 4 lines, British ships are only running 1 line. So plaster is very scarce. As regards every other product, bathrooms, kitchens, they're all fixed price, and therefore the prices have been agreed at the beginning of the year. So happy days, there's no price increase. There is movement in the marketplace generally because of scarcity of supply. So just be careful. If you're an LMPG member, just follow the instructions on the websites, and make sure if there's any discrepancy, let us know and we'll get it sorted for you.
So just to bring you into this question debate more than anything else, we talk about big projects, and we talk about getting contracts in place for people not to, so you've got a builder who quotes you at £30,000, and I'm sure people listening in have had the same experience I had, whereby they start a job, they kick down part of a wall and say, oh, I thought it was going to be 30,000, it's now £45,000. How do people actually protect themselves from these builders that seems to rip people off?
Well, I think there are a number of ways. Number one is due diligence. I'm always amazed by how many people in the property community don't do enough due diligence. There's an enormous amount of work you can do to check people out, because sometimes people have a dodgy reputation. Unless you really research, you won't find it out. But in terms of what you do, there are obviously a number of ways of dealing with this in terms of contracts, and there are various forms of dealing with it in terms of whether you pay them a standard sum to produce the whole thing, or JCT contracts, which obviously are quite popular. But if you do get a JCT contract, I'd certainly always suggest you get a solicitor who really understands and to draft them for you. And certainly when it comes to larger projects, we'd always recommend that. We actually work with a guy, not with us, he doesn't work with us, but he's got his own business, who actually specialises in JCT contracts and construction contracts. And we certainly often recommend him. But it can make quite a difference. I had a huge learning curve when I did my first commercial conversion. I got someone to do a JCT contract with the builder, but we had another look at it and actually saw he hadn't bothered to put in any penalty clause. Now, this builder was actually turned out to be hopeless, hadn't done the due diligence, but because he started becoming so far behind, there was a penalty clause of £1,500 a week. So after 3 months, he was behind. We whacked a whole load off what he was due, and he was happy to be sacked because, of course, he was just going to get paid nothing. He was so far behind. But if we hadn't put that penalty clause in, we'd have been in all sorts of trouble. So I think, therefore, as ever, it's getting the right paperwork in place. And the one thing that does concern me about the property community is a lot of people, going back to what you were saying earlier, talk to a bloke down the pub, get something online. Now, sometimes, it's great to share information, but when we're talking about specialist legal contracts, I do think people do try to cut corners. You do need specialists. And on a more general basis, I'm always horrified by how many people, when they go into bed together in business, actually don't have a contract at all. In fact, they do have a contract, but it's just not in writing. And therefore, they get into all sorts of problems down the line. And we're starting to see that more. And I'm predicting the next 2 or 3 years we'll see far, far more of that, because an awful lot of people haven't got into bed properly, haven't got the proper contracts in place. If they've set up a company with somebody else, they haven't got a proper shareholders agreement. If they're in a partnership, there's no partnership agreement. All these things, I think some people who get excited about being an entrepreneur see it as rather boring and perhaps unnecessary, but it's not. The example I always give, if you're buying a house, would you buy insurance? Of course you would. In which case you also need to have the proper legal contracts in place and, of course, the right accounting advice.
Keeping on the theme of getting into bed together and contracts, let's talk about divorce, because that's obviously, you know, we've had a lot of friction with people staying together, even just the next door neighbor, high entertainment value of each of them shouting at each other with the windows open, very entertaining. But from a perspective of, you know, property investors and people saying, well, I bought this property in my name, and I do get calls for people saying, well, I'm a bit worried if we get divorced, what, you know, the property is in my name, it's protected, isn't it? The question over to you, Tim, is it really protected? I appreciate you're not in family law, but from
well, actually, I was a divorce lawyer until about 10 years ago. So the answer is no, they're not protected. There's a big difference between being married and unmarried. If you're married, the starting position is it's family property, end of story. And therefore it's available distribution. And in a nutshell, if it's a very short marriage, you may come out of it with what you put in. If it's a long marriage, the starting position is going to be a straightforward division. Now, family assets include pensions, they include property, and just about everything else. And the only way really to avoid that is with a prenuptial agreement. Now, they're not necessarily enforceable, but the courts are starting to look at those more seriously. But in a nutshell, basically, if you're going to get divorced, in theory, all of that property, anything you own, anything your spouse owns, is potentially up for grabs for division. Not always 50-50, but it is available. So can you protect it in broad terms? No.
Is there a division, not going on this subject too long, but is there also an aspect of cohabiting and having to divide the assets, or is it just married people?
Cohabiting is very different. And again, I think this is going to be an issue that's going to come up more and more because so many more people are living together compared with being married. But the position is very different. And there is no, some people think there's something called common law divorce. It simply doesn't exist. There are no automatic property rights. Therefore, you'll start having to look at who put the money into the property, who paid the mortgage, who made the upkeep, who paid for maintenance of the property. It's far more dividing what someone has put in. But marriage is completely different. Completely different.
Good. I just threw it out there in terms of a question. If you're listening to this and you really appreciate the insights that the property expert panel are giving to you, make sure you do give this video a like. It really does help us get feedback, whether it's good or bad. So please do give us a thumbs up if you do appreciate it. If you do have any further questions, then please type those questions in. And we'll do our damnedest to get to answer those questions as we go through. I just want to talk about the thing about inheritance tax planning, and it's inheritance tax itself. But the one thing I want to focus it on is for those people that have, and we talked about the scenario of husband, wife, civil partner. One person has got the property, got the mortgage in their own name. Rather than just thinking about IHT planning, I think you need to talk about mortgages. Simon, just to bring you into this, what risks do people have when they're in a family situation, but they get the property just in their name and they've got this, you know, mortgage just in their name as well? Well, things with COVID-19 and so on, is there great risks for the rest of the family?
Just so I fully understood what you've asked, Simon. So effectively, we've bought a property. It's not in a limited company. It's gone into personal name, and it's gone into, let's say, Dad's name for ease, just because it was easy when they were doing the application to send one lot of documents across, which does happen, amazingly. It should never be the reason why you choose a particular type of mortgage or a type of application, but it does happen. I guess that's going to come down to then the points that Tim's been covering, if you're married or not. So if you're not married but you're cohabiting, then the mortgage responsibility comes down to that one person who's on the mortgage documents, effectively. If you're married, then it's a married asset that works in reverse. i.e. the debts have to be paid and satisfied before you can divide the assets on disposal and winding up effectively, if that's what you call it, the marriage. Yeah, so assets really should be listed up. I think if you've got two parties within the household, both parties need to be on the application, simply because it's an asset, and then should the worst happen, the asset is then fairly divided up. Just bear in mind that you've got to make sure that if that person that you are connecting yourself with is financially reckless, that it will also come back to hurt you. And quite often,
I mean, just on that point though, Simon, I think I was kind of alluding to, if you have got a couple in a relationship, they're happy. Yeah, let's think about that. But if they are in a happy relationship or not, but happy relationship, should they have both people on the mortgage application? Because if once something happens to that one person, the other person then has to go for a reapplication, and they haven't got a job because they're dependent on the property income. Could there be in difficulty?
Do you know, yeah, you're absolutely. Yeah, I hadn't actually thought of that from that angle. Yes, totally, absolutely. From a complete safety perspective, yes, absolutely. Because then, as you rightly point out, they have an income, whether they've been working or not, because they're on the tax return for the rental income. So effectively, then get subsequently taking on the full mortgage if they need to, and yeah, it's easy to do, definitely.
I'm just going to go on a slight tangent here, because one thing we haven't really talked about tonight, and I've started seeing this on the news a little bit more, is rent fixing. Now, the Labour Party was pretty much pro this, of saying, right, we're going to fix the rent. You can't go above that rent. Teresa and Jenny, what's your thoughts in terms of the political side of things? Do we think we're going to see this rent capping coming into play very soon?
I hope not, is the answer. I was reading something earlier today. There's a London renters union, and they've called for a rent strike just because they don't feel they should be paying their rent. Seems to fall very short of the fact that landlords actually are not these rich people that everybody perceives, and that most of the landlords actually need the rent in order to pay the mortgage and keep the house. And if the landlords don't get the rent, ultimately the house could get repossessed, and then the tenants lose their property anyway. I think it would be a very sad state of affairs if market forces didn't actually regulate our rent prices. Yes, there is a lot of a difference between social housing and private sector, but the fact that the government can't provide enough houses, they need they need the private rented sector. We're not getting very good press. We haven't for the last probably 5 years. But if we all went on strike for a month and said, no tenants for a month, the country might then sit up and take some notice that they do need us. We're offering a very needed and valuable service, and it needs to be market rent. But what I would say is that the universal credit housing benefit element currently does not cover 100% of the market rent in the area. It might cover 70%. That's where this needs to be sorted out. If people are on benefits and they can't get a council house, they need to go in private rented sector, housing benefit should cover the local market rent, not 70% of the local market rent. How are these people supposed to make up the difference? And I believe that is the crux of this problem. And, we're in it to make a profit, but we want to look after our tenants as well, most landlords out there. So it needs to be fair, but we also need we're taking all the risk. We need to have a profit out of this. So I believe market forces should be what sets the rent, not the government. And the government could help by supporting the universal credit housing benefit element of universal credit up to the right level.
Good point. Teresa, what's your thoughts on that subject?
Yeah, it's totally, agree with what Jenny's just said. The NRLA definitely do not support fixed, capping rents at all. And this is where our lobbying efforts come into the fore, where we're we provide the evidence as to why it is a bad idea. So, you know, providing the government with the research and evidence, you know, on how it would affect the market. Because, I mean, as Jenny said, you know, they've already hit landlords quite hard with taxation and legislation, and then just to put in you know, rental caps, I think that might just be the icing on the cake. So yeah, no, we're definitely not supporting that.
Okay, Simon Hodgson, get in.
Well, a couple of points. First of all, if there's a rental cap, okay, lenders lend based on a stress test, so they'll use a notional interest rate against the rent that's received, and then from that they'll then decide how much they can lend. Now, if you put a market rent cap on there, that completely kind of skews how the lender lends. And then I think the other thing really to say is, which I'm pretty sure Bronwyn's going to kind of echo and agree with this, which is a rental cap is effectively like putting a plaster on a massively open wound, yeah, or treating a symptom rather than the cause. And the cause, effectively, we have to remember, is there's not enough house building going on. Yeah, as landlords, we are helping the government make a shortfall up effectively by creating HMOs, creating these additional rooms, where society has a trend to whereby families aren't necessarily staying together as long, and one of the family members is leaving the family home and needs cheaper accommodation, or you've got transient workers again who need cheaper accommodation, who don't want to or can't afford to, based on their income, to rent 1-bed, 2-bed flats. So the market has been created by a government or successive governments that just have not met what needs to, you know, it sounds simple, doesn't it? Build more houses, yeah? Because you know, one thing's for sure, if you put a rent cap in, you are effectively pressing down a hole on a leaky bucket that's got more than one hole, and all that's going to happen is that the water is going to come out of another hole. Yeah, you can only stop the water coming out of the bucket by fixing the problem. Fix the problem, yeah, build more houses, and the market will find its own level set. Yeah, that's the way I see it.
Yeah, fully agree.
We've got 5 minutes left, and a question has come up several times before this session started, and I can still see questions coming in about the same subject. Is around, I've got a pot of money, where do I start on my property investment journey? I'm going to go over to Paul, and then we'll conclude the session with Bronwyn's thoughts on where you should invest your money. So Paul, if someone got £120,000, let's go over to your thoughts first, and then we'll go over to Bronwyn.
I would always say, make sure you've got the experience of where you want to invest in it. The last thing you want to do is put it into commercial if you've got no experience of commercial. Similarly, why would you buy a HMO if you've only got single buy-to-lets? Unless you JV with someone, i.e. joint venture, find a partner who's done it before, got the experience, and joint venture with them. And that way you can spread that pot of money further, because there'll be more than one person with that pot of money. So definitely research, educate, and then invest. I wouldn't, or educate, research, and then invest. You know, whichever way you want to do it, make sure you do the first two things before you do the investing. Otherwise, you could end up just investing that money into that bucket that Simon's got under his desk.
Okay, yeah, so the key, as Paul said, really is about what knowledge have you got, what's your level of risk, and what are you comfortable with. £120,000, for example, it's pretty much what we started out with by refinancing our home. You know, you've got to use leverage. If you want to create wealth, you do need to use the ability to borrow money. Leverage, that's what I call leverage, by borrowing at low interest rates to create cash flow and future capital growth. That's definitely where property can work extremely well. So borrowing from banks, mortgages, is critical, I think, if you want that money to go as far as possible. So there's a lot of deposits in that. So deposits 25% of the value of a property. So depending on where you're investing, that could be several single buy-to-lets, for example. Now you could put it all in the stock market, but you have no control over that. Whereas if you get an education in property and you understand the risk, then you've got more control than putting it into the stock market. That's my personal opinion, of course. So the key for me is get that education, go at the pace that you're comfortable with. Don't try and do something that someone else tells you to do just because they've done it before. Do your due diligence. You can also work with other people. So yeah, I borrow from investors. I've got more knowledge, they've got the cash, I give them a good return. But they've not got the asset generally. I've got the asset. So if you want to make both sides of the equation work, then it's really about doing it yourself. So yeah, lots of opportunity. I'd say get a copy of my book. Tells you a lot in my book. Here we go, Building Your Dream Life. If anyone wants to message me and would like a copy of that, I'd be happy to share.
Bronwyn, thank you ever so much for that. And I appreciate, normally we do a summary, but I thought there was so much good questions coming about. I think it's going to be quite difficult. But do you want to summarize from tonight's bit, and then I'll talk about the next events, Bronwyn?
Yeah, absolutely. Here we go. I can't believe where an hour and a half has gone. Look at the expertise. I know we've got so many questions we haven't answered. But I'm more than happy, and I'm sure my colleagues are as well. If you want to come through to any of us, more than happy to answer your specific questions. Or if you want to come through to me, I can then introduce you to anyone else on this event. So my mantra again, work with experts. That means I don't have so much stress. I don't have so much risk because I'm using these people to give me advice. I'm trying to sell 8 houses at the moment. I'm also incorporating my properties that are in personal names. So I'm going through quite a lot of interesting change at the moment. So again, if any of you out there want any advice on that, I'm happy to share what I'm going through at the moment. So yeah, thank you ever so much, Simon, for hosting this event and for everybody taking part. I know we're all getting some great knowledge ourselves from this. I'm learning loads. It's really good to be amongst people who can help me with the right advice. There's so much out there, isn't there? How many webinars have you been invited to and Zoom calls? And you just think, does this person really know what they're talking about? You've got some good examples here. So thank you, everybody. It's been a great event. And
don't forget, we are back on the first Monday of every month, which is the 6th of July, in fact. So 6th of July, we will be back at 7 p.m. until kind of 8:30-ish as before. We will be questions underneath the description box, so you'll know what questions have been asked. But equally, as Bronwyn just said, if you have any questions at all, please feel free to drop those in the comments box, and I will also be fielding those questions out and try and get answers to you. So from me, Simon Mishevich of Optimize, thank you ever so much for joining us. And from the rest of the expert panel, who wants to say goodbye, say goodbye.
Yeah.